Welcome, ladies and gentlemen, to KPMG's Accounting and Reporting webinar on Are You Ready for 31st December 2020 Reporting? I would now like to hand over to your host, Kim Heng. Kim, over to you.
Thank you, James, and welcome to today's webinar. My name is Kim Heng, and I'm your host for today's webinar. I'm a partner in our Department of Professional Practice. It's a group that helps clients and KPMG staff with interpreting and applying IFRSs and other financial reporting requirements. Joining me on this webinar is Aaron Lowry, a director, and Hayley Pang and Denise Fong, both senior managers within the firm. Here we put today's webinar topics in context. COVID-19 has brought an increased level of uncertainty in economic markets, both locally and globally. The government provided and extended COVID-19 support. Our regulator, ASIC, extended reporting deadlines, and the international standard setter rushed through an amendment to the Leases standard to try and ease the accounting burden for lessees who receive rental concessions. COVID-19 continues to impact the financial prospects and reporting of many organisations. ASIC and other stakeholders remain focused on how organisations have considered the impact of COVID-19 on accounting judgments and estimates when preparing the financial statements. Moving away from COVID-19, ASIC continues its various surveillance activities, and the international and local accounting standard setters show no signs of slowing down. Today, we will touch on some of the new accounting standards, amendments, and agenda decisions effective and forthcoming. The changes to our Australian financial reporting environment are also worth the mention. From the changes to the reporting thresholds applicable for the first time for 31 December 2020 year-end organisations to additional recognition and measurement disclosures for certain not-for-profit entities. With all this in mind, let's look at our agenda for today. In today's webinar, Denise will briefly remind us of the key impacts COVID-19 may have on 31 December 20 reporting, as well as provide some observations from the recent June reporting season. Hayley will discuss the new accounting standards effective for the first time for 31 December. Aaron will then share with us some topical issues worth thinking about this upcoming reporting period. Denise will come back and take you through what our regulators are concerned about. Finally, Aaron will provide an update in relation to the Australian Financial Reporting Reform Project before I wrap things up and we respond to questions. This webinar has been pre-recorded, however, we are doing Q&A live. Therefore, if you have any questions, then please submit them using the Q&A function, and we will try to address as many of them as possible at the end of the webinar. If we do not get to your specific questions, we will answer them through your usual KPMG contacts separately following today. Next week, we'll be uploading both the recording of this webinar and the slides to our external website where you will be able to access them. I'll now hand you over to Denise.
Thanks, Kim. So as a reminder, here are some of the financial reporting areas that are likely to be affected by COVID-19. If you would like a refresher on the key financial reporting considerations on these topics, please refer to Part 1 of our June webinar. Today, we'll be focusing on what we can learn from the 30 June 2020 reporting season, as we expect these will also be a focus area of the 30 June ASIC surveillance program. Unsurprisingly, of the ASX 200 June reporters, impairment of non-financial assets and financial instruments were the key disclosure areas that contemplated COVID. We will share some of our key observations and critical success factors for audit readiness in these areas shortly. Just briefly, for government assistance, we have seen a handful of June reporters who have disclosed JobKeeper and other COVID-related government assistance. The majority of these were presented on a net basis. With the changes to JobKeeper, companies should reassess their eligibility. However, the accounting will be the same as the original JobKeeper payment. A critical success factor for audit readiness will be to maintain appropriate records, such as the projected GST turnover calculation, to support eligibility in receiving the JobKeeper payment. For going concern, only a handful of companies disclosed their basis for the going concern assumption, and of those, only a few had detailed their key considerations made by management to support the assumption. In our experience, detailed records of forecasting, analysis of significant future events, and plans to address these will be necessary for your audit to run smoothly. Finally, for leases, only a few June reporters had applied the rent concession amendment, though we do expect that more entities will be applying this for their December year ends, as many lease negotiations are expected to be agreed by then. Aaron will talk you through the accounting details later in today's webinar. For impairment of non-financial assets, ASIC has included in their COVID FAQs a range of factors you should consider in relation to asset values. ASIC has also emphasized that the best estimate should have regard to risk factors, for example, through the discount rate used in a discounted cash flow model. They have also mentioned that given the uncertainties in the current environment, it may be necessary to use a probability-weighted scenario approach to determine the fair value and value in use estimates. Critical success factors for audit readiness are to have a clear pathway on why these approaches were taken and the assumptions made, and to clearly show what sources were used to support the key assumptions and their credibility. We recommend discussing this with your auditors early to avoid any last-minute questions on the estimation uncertainty arising from these decisions. Further, impairment tends to be a common topic in audit reports for listed entities as a key audit matter, or CAMs, and for the June reporting season, we've observed that many impairment CAMs have referred to the impact of COVID. Turning to the financial statements, most companies have clearly identified both COVID impacts as an indicator of impairment and that the impairment assessment as a key source of estimation uncertainty. In capturing this uncertainty, we noted there was mixed practice, with some adding a risk premium to their discount rates, whilst others adjusted for uncertainties through their cash flow forecasts. Many disclosures also included statements about forecasting based on experience and expectations of the future in light of COVID. However, these were often brief or generic. Some of the better disclosures we have seen provide clearer explanations for key assumptions used in forecasts, which provided insights into management's thinking and how they arrived at the impairment estimate in the COVID environment. For example, these disclosures explain that cash flow projections for certain CGUs did not have a significant COVID impact, as the main customer base are government related. It also explains management's expectations of a return to normal from year 2 of their cash flow forecasts. We also observed a few entities who had adopted a probability-weighted approach in modeling their cash flow forecasts to capture the uncertainties related to COVID. The disclosures explain the different economic scenarios used and disclose both quantitative and qualitative information of key inputs specific to each scenario and tenor over the forecast period. Moving on for financial instruments, ASIC has emphasized in their FAQs that in the current environment, a qualitative approach should be applied in determining expected credit losses for loans and receivables. For example, careful consideration should be taken to understand whether or not a payment deferral request indicates a significant deterioration in the customer's credit quality, or if the customer is just taking advantage of a general relief program that is offered to all customers. Entities should also obtain current information about the circumstances and financial condition of borrowers and debtors, and consider both short-term liquidity issues and the financial condition and earning capacity of borrowers and debtors. From what we have seen, there has been a general increase in expected credit loss provisions, with many entities adopting an overlay approach. From a disclosure perspective, there has been a varied level of disclosure over key assumptions, and though many disclosures surrounding ECLs on trade receivables were brief and or included generic statements of how forward-looking information was incorporated into a historical loss model. Surprisingly, we've also not seen much disclosure on how entities' credit and liquidity risk management practices have changed as a result of COVID. And for corporates, there was also a lack of sensitivity analysis of key inputs used in determining the ECL estimate. Better disclosures that we have seen in the corporate space provided explanations on how credit risk of their trade and lease receivables and contract assets have been assessed. For example, some entities have listed out their key considerations in assessing whether a debtor has a high, medium, or low credit risk, and some have explained their segmentation approach and how different customer types are categorized. Where your segmentation approach has changed, we recommend you discuss this with your auditor as early as possible to avoid any potential rework. Better disclosures we have also seen explain changes to key inputs and assumptions used in the ECL model and provide both qualitative and quantitative information. However, as I previously mentioned, many corporates have not included sensitivity analysis and scenario analysis where appropriate. Unsurprisingly, though, these disclosures have been done well by the banks. And given this is an ASIC focus area that covers all industries, we thought we would share with you some examples of sensitivity and scenario analysis disclosed by the banks. You may want to consider these and amend to suit your specific situation. One of the other key areas that ASIC has emphasized is the importance of disclosing the impact of COVID and other significant drivers of an entity's results. This includes disclosing the reasons why an entity may not have been impacted by COVID at all. In doing so, entities should be mindful of ASIC's expectations surrounding alternative performance measures and how performance is explained in both the OFR and financial statements. For instance, in ASIC's COVID FAQs, they communicated that removing the impact of COVID in alternative performance measures are likely to be misleading and often hard to reliably identify and separately quantify. In addition, presenting a split of profit or loss or related items into pre- and post-COVID periods are problematic and may also be potentially misleading. And ASIC has specifically warned that this should not be shown on the face of the income statement or in the notes to the financial statements. This includes segment reporting. I will now pass on to Kim to share her insights on some of the new tax measures in the federal budget announced earlier this month.
Thanks, Denise. In its budget announcement, the federal government introduced a number of new measures to provide cash flow support to businesses and to stimulate investment. Two key measures introduced and almost immediately substantively enacted were the extension of the instant asset write-off provisions that were first introduced in March 20 and the temporary loss carryback provisions. Even though the asset write-off measures are new, they are similar to previous asset write-off measures, which we did discuss in our 30 June 2020 Part 1 webinar. So I do refer you to that. And so therefore today we'll only be focusing on the tax carry loss measure. The last time Australian businesses had the ability to carry back tax losses was in 2012-2013. However, at that time, the ability to carry back these losses was very limited and short-lived. The optional tax loss carryback rules introduced in October this year apply to businesses with an aggregated turnover of less than $5 billion and gives corporate tax entities the option to carry back tax losses generated between the 1920 and 21-22 income years to offset previously taxed profits in the 18-19 or later income years, effectively resulting in a refund of previously paid taxes. However, the clawback of taxes previously paid can only be claimed on lodgement of the 2021 and the 21-22 tax returns, and the amount of the tax refund is limited to the taxes previously paid in the 18-19 or later years, and the availability of franking credits in the claim year. For tax effect accounting purposes, when organisations incur tax losses in its 19-20 or 21-22 years that it intends to carry back, the application of these measures could result in a tax receivable for the amount of the tax losses intended to be offset against tax paid in previous years, an increase in previously unrecognised deferred tax assets for temporary differences expected to be realised in the 21-22 years and able to be carried back, and a decrease in income tax expense. Although these tax loss carryback measures are retrospective, this tax legislation is a non-adjusting subsequent event for organisations with reporting periods ending prior to the 9th of October 2020. Not appearing on this slide, but also part of the budget announcements, is an increase in the rates of both the refundable and non-refundable R&D tax incentives, which will apply for years commencing 1 July 21. For more information on these tax measures and the tax effect accounting implications, please check out our COVID-19 FAQs on our website. I'll now hand you over to Hayley.
Thanks, Kim. There are a number of new accounting standards which are newly effective for 31 December 2020 year ends and half-year reporters. The first one to highlight is the change to the definition of a business test. The amendment enables a shortcut asset concentration test that may simplify the crucial conclusion of whether an acquisition is a business acquisition or asset acquisition. This assessment affects whether goodwill and deferred taxes are recognised on acquisitions and how contingent consideration is accounted for. Whilst effective now, a number of entities may have early adopted this amendment if they entered into transactions recently, given the attractive shortcut approach. For more information on the new definition of a business, you can refer to the video and web article on our webpage, and if you have access, our KPMG Insights into IFRS book or ebook. Next are the amendments to AASB 101, providing further guidance on what is material for the financial statements. What is material has always considered the impacts of omissions or misstatement of information that could affect the decisions of the users of the financial statements. The definition now also considers obscuring information, which essentially challenges us to consider whether hiding the most useful and relevant information with less relevant information could reasonably be expected to influence the users of the financial statements. The reform of interbank offered rates, or IBOR, the benchmark interest rates that underpin the measurement of many financial state instruments, is a key issue facing companies. The IASB has a two-phased approach to grant accounting relief on this issue. Phase 1 amends specific hedge accounting requirements to provide relief from the potential effects of uncertainty caused by IBOR reform and is effective for December reporters. Phase 2, which deals with the impact of IBOR reform on areas other than hedge accounting, has been issued with a later effective date. We discussed IBOR reform in more detail in our December 2019 reporting webinar. If you have hedging relationships linked to floating rates, such as LIBOR, we recommend you to refer to our recorded webinar. Two additional standards that have an impact for December reporters are the disclosure of new IFRS standards not yet issued in Australia, which covers the gap between when the IASB and AASB issue standards, and the deferred AASB 1059 service concessions for government grantors. Our webinar today is focused on for-profit organisations, but for those of you interested, just a quick reminder that there are specific not-for-profit changes relevant for 31 December year ends. These include research grants accounting and disclosure in special purpose financial statement of not-for-profit private sector entities on compliance and with recognition and measurement requirements. These not-for-profit focus standards applied to entities with years beginning on or after 1 July 2019. As such, June year ends would have applied these amendments in their 30 June 2020 reporting, but for December year ends, December 2020 is the first time these standards are effective. For publicly accountable for-profit entities, the new conceptual framework is applicable for December reporters. The conceptual framework is a useful reference point when no specific standard addresses the accounting for a transaction. In addition to what's listed on the screen, the revised conceptual framework introduces a reporting entity definition that has led the AASB to replace the existing reporting entity concept, which is based on users' information needs. Finally, there is one amendment which is effective for annual reporting periods beginning on or after 1 June 2020. This means it is effective for December half years, though we expect many December year ends will early adopt the amendment. The COVID-19 related rent concession amends AASB 16 to provide an optional practical expedient that simplifies how a lessee accounts for rent concessions, such as reduction, deferral, or changes in rent that are a direct consequence of COVID-19. We will cover this practical expedient in more detail later on. There are also several standards available for early adoption, as you can see on this screen. We don't plan to touch on all of them, but we'll highlight a few. Amendments to the provision standard relating to accounting for onerous contracts. The amendments clarify that when assessing whether a contract is onerous, the cost of fulfilling the contract includes both the incremental costs of fulfilling that contract and an allocation of other costs that relate directly to fulfilling contracts. The amendment is effective from 1 January 2022. Aaron will discuss this in more detail later on. Interest rate benchmark reform phase 2. The amendments include adjustments to specific requirements in accounting standards relating to modifications of financial instruments and lease liabilities, hedge accounting, and disclosures. The amendments are effective in 2022. Amendments requiring a liability to be classified as current when companies do not have a substantive right to defer settlement at the end of the reporting period. Application of this standard has been deferred to years commencing on or after 1 January 2023. And finally, AASB 2022, the removal of special purpose, and AASB 1060, the new simplified disclosure standard, form part of Australia's new financial reporting framework. Refer to the recording of our June 2020 webinar on these Australian Financial Reporting Framework for further information about these standards and the relief available upon early adoption. Now let's move across to the IFRS Interpretations Committee's agenda decisions. As a reminder, agenda decisions are a way of making a statement about why a change of an IFRS standard requirement or an interpretation of that requirement is not necessary. They often include explanatory information that is intended to provide guidance for the consistent application of IFRS standards. As a result, agenda decisions form part of IFRS guidance and they must be followed in order to claim compliance with the standards. There have been recent updates to the IFRS Foundation's Standard Setting Manual focused on enhancing due process by formally involving the IASB in the finalisation of agenda decisions. Before it is published, board members will be asked whether they object to an agenda decision. If 4 or more board members object, the agenda decision is not published and the board decides how to proceed. As mentioned in previous webinars, a company is expected to change their accounting policies if their current policy is inconsistent with the agenda decision. The IASB expects companies to be entitled to sufficient time to implement changes to accounting policies, but does not set an effective date for when that occurs. Therefore, companies need to consider agenda decisions and implement any necessary accounting policy changes on a timely basis. In other words, as soon and as quickly as possible, and likely in the next set of financial statements. There have been 3 final agenda decisions since our May webinar, all of which have been approved by the IASB. We consider all of these decisions to be of low impact given their likely frequency across entities. The first decision related to whether a football club transferring a player for which the registration right is an intangible asset recognises the transfer payment as revenue, or instead recognises a gain or loss applying the intangible asset standard derecognition requirements. The next decision was on how to account for deferred tax related to undistributed profits of a subsidiary in a jurisdiction in which income tax is payable only on distribution of profits. For further information on these decisions, refer to our summary of recent final and tentative decisions, which is available on our website. What we would like to spend a little more time on is the final decision on how to account for a sale and leaseback transaction where the market payments under the leaseback include variable amounts calculated by reference to the lessee's revenue. Let's have a look at an example. When accounting for a sale and leaseback transaction where the transfer of the asset to the buyer lessor is a sale under the revenue standard, the accounting is determined as follows. The underlying asset, the PPE, is derecognised and lessee accounting is applied to the leaseback. The right of use asset is measured at the retained portion of the previous carrying amount of the PPE. And only the gain or loss related to the rights transferred to the lessor is recognised. The question asked to IFRIC was how to measure the right of use asset retained when the lease payments include variable payments calculated as a percentage of revenue, that is, variable lease payments which are not based on an index or rate. Should a right of use asset of 0 be recognised, given the cost of a right of use asset comprises the lease liability, and lease payments which are variable based on a percentage of revenue would not be included in the measurement of a lease liability based on the guidance in the leases standard? Or can the variable lease payments be included in the right of use asset in a sale and leaseback arrangement? The discussion at IFRIC acknowledged that measuring the right of use asset at 0 would not reflect the retained portion of the PPE. The leases standard does not prescribe a particular method to use in determining the right of use retained, and therefore the present value of expected leaseback payments, including variable payments, at market rates could be included. Let's have a look at a quick example to illustrate what this means. Entity X enters into a sale and leaseback transaction whereby it transfers PPE to entity Y and leases it back for 5 years. The transfer of the PPE is a sale, applying the requirements of the revenue standard. The carrying amount of the PPE is $1 million, and the sales price is $1.8 million. Lease payments at market rates are variable, based on a percentage of entity X's revenue. The present value of expected lease payments is $450,000. We won't go through the full accounting for this transaction, but we'll touch on some of the key calculations. So firstly, the right of use retained can be calculated using the expected lease payments as a portion of the fair value of the asset. The right of use retained is therefore $450,000 as a portion of $1.8 million, which is 25%. The right of use asset is calculated by multiplying the right of use retained, 25%, by the carrying amount of the PPE of $1 million. This means that the right of use asset recognised would be $250,000. To calculate the gain related to rights transferred to the lessor, 75% being the right of use transferred to the lessor, is multiplied by the difference between the sales price of $1.8 million and $1 million being the carrying amount of the PPE. This equals $600,000. This particular discussion and the clarifications provided raise the question of how a seller lessee should apply the subsequent measurement requirements in the leases standard to the lease liability. Subsequent measurement of a lease liability which includes variable lease payments other than those based on an index or rate are not specifically contemplated in the leases standard. Watch out for an exposure draft on this topic. Looking ahead, shown on this slide are some of the minor amendments the IASB has finalised, all of which are expected to be issued before the end of this year. I will now hand you over to Aaron.
Thanks, Hayley. In this next section, I will take you through a couple of financial reporting hot topics, which you should keep in mind for the upcoming 31 December reporting season. The two things I wanted to talk to you about are, first, the amendments made to AASB 16 leases for COVID-19 related rent concessions, and second, amendments made to AASB 137, which clarifies the accounting for onerous contracts. In our June COVID-19 webinar, we briefly discussed the impact of the amendments to AASB 16, which introduced a practical exemption for rent concessions for lessees. This is expected to be a hot topic for entities with a 31 December year end, as many of them that are lessees could be applying the practical expedient for the first time in their 31 December accounts. In recognition of the practical difficulty that could arise from having to apply and consider changes to a large volume of leases, the IASB approved a simple and narrowly focused exemption. Firstly, the practical expedient applies to lessees only. A lessee may elect to account for a COVID-19 related rent concession as part of the existing lease contract and not need to consider whether it is a lease modification. The practical expedient applies only to rent concessions occurring as a direct consequence of the COVID-19 pandemic and only if a number of conditions are met, including A, the change in lease payments results in revised consideration that is substantially the same as or less than the consideration for the lease immediately preceding the change. B, any reduction in lease payments affects only payments originally due on or before 30 June 2021. And C, there is no substantive change to other terms and conditions of the lease. Whilst a lessee that applies the practical expedient is not required to assess whether rent concessions that meet the conditions are lease modifications, there is no explicit guidance in the amendment on how to account for rent concessions if the lessee elects to apply the practical expedient. Our view is illustrated here, but with no explicit guidance, we are seeing different views in practice on how to account for rent concessions. Therefore, we recommend discussing your proposed accounting approach with your auditor in advance of year-end. Let's look at an example of how a lessee would apply the COVID-19 practical expedient to a form of rent concession that we expect to be fairly common in practice, whereby the lessor has granted an unconditional forgiveness of rent. Here, we have a 5-year office lease which commenced on 1 January 2018. The lease payments are $100,000 per month, payable in advance at the beginning of each month. Due to the impact of COVID-19 on the lessee's business, the lessor agrees to forgive the lease payments for the 3 months of August, September, and October, beginning 1 August 2020. So the question is, how should the rent concession be accounted for if the lessee elects to apply the COVID-19 practical expedient? In this example, the lessee would account for the waiver as negative variable lease payments on 1 August 2020. As a result, it will reduce the lease liability by the present value of 3 months waived lease payments discounted at the original discount rate with a corresponding amount recognized in the profit or loss. And secondly, continue to accrue interest on the lease liability at the unchanged discount rate. This simple example illustrates how an entity might account for an unconditional forgiveness of rent. However, rent concessions granted by lessors may take many different forms. Therefore, lessees need to carefully evaluate the details of the rent concessions to determine an appropriate accounting approach. There is no one-size-fits-all answer to this issue, and so we encourage you to reach out to your KPMG contact if you need guidance on more complex scenarios. Now, you may be wondering what the impact of this amendment is on lessors. And well, the answer is not much, and that is because the practical expedient does not apply to them. Therefore, lessors need to consider whether there is a lease modification that arises from granting a rent concession. Now, if negotiations are still ongoing and there is no agreement between the parties on the terms of the rent concession, the lessor should continue to account for such leases as per the terms and conditions of the original contract. The lessor should, however, consider whether expected credit losses should be recognized on lease receivables originating from such leases. When an agreement is reached between the parties on the terms of the rent concessions, to account for rent concessions, the lessor should apply the lease modifications guidance in AASB 16 as they would for any other lease modification. It is important to note that if an agreement is reached after year-end, it is a non-adjusting subsequent event, and it should not be accounted for in the reporting period, although some disclosure may be required where the impact is expected to be material. For lessors, the accounting for rent concessions will depend largely on the nature of the concession granted and whether it is a finance lease or operating lease. The accounting for lease modifications can again be complex, and so for more practical guidance and examples on accounting for rent concessions for both lessees and lessors, you can also refer to the KPMG publication on this topic. The next thing I wanted to tell you about was the recent amendments to the provision standard, AASB 137. But before I get into the detail about the amendments, I should first give you some of the background to this issue. The transition to AASB 15 resulted in the withdrawal of AASB 111 construction contracts, and along with it, the guidance used by entities to account for loss-making or onerous contracts. Under AASB 111, entities considered all costs attributable to the contract when determining if a contract was loss-making and in measuring any resultant provisions. The withdrawal of AASB 111 meant that entities needed to apply the guidance in AASB 137 to account for onerous contracts. However, the language used in AASB 137 is somewhat different, as it refers only to the costs that are unavoidable. And herein lies the issue. There is no definition of what constitutes an unavoidable cost. However, in our view, unavoidable costs included only incremental costs. That is, incremental costs included only those costs that an entity would not incur if it did not have the contract. The consequence of this was that onerous contracts would be smaller and recognised later than they were previously. Now, there has always been a degree of diversity in practice in relation to which costs should be considered in accounting for onerous contracts. However, it was largely contained to things like service contracts that were not in the scope of AASB 111, but were in the scope of AASB 118, the previous revenue standard. Since the release of AASB 15, there has been concern that diversity could increase, given AASB 137 now applies to all revenue contracts. In response, the IASB and subsequently the AASB have taken steps to amend the accounting standards to clarify which costs need to be considered. So let's look at the amendments. The Accounting Standards Board has, via an amendment to AASB 137, clarified that the costs of fulfilling a contract comprise both the incremental costs and an allocation of other direct costs. In other words, it is an approach that is more consistent with what was being done under the construction contract standard prior to the implementation of AASB 15. This means that while those entities that have continued to apply a full cost approach are not likely to be affected, others that have been applying an incremental cost approach will need to revise their accounting policy and implement this change prospectively from the date of application of the new amendments, potentially leading to more onerous contracts and higher onerous contract provisions. Some examples of costs that would be included under a full cost approach that would not be included under an incremental cost approach includes depreciation of plant and equipment used on the project, an allocation of the cost of permanent staff, and other general construction overheads. Ordinarily, the transition rules for these types of amendments would be relatively straightforward. However, there are some differences with this change that entities may need to give some thought to. The first thing to note is that the amendments will apply for annual reporting periods on or after 1 January 2022 to contracts existing at the date when the amendments are first applied. At the date of initial application, the cumulative effect of applying the amendments is recognised as an opening balance adjustment to retained earnings or another component of equity as appropriate. Early application is permitted. However, the important thing to be aware of is that the amendments have strict transition rules, which don't allow the comparatives to be restated. Therefore, comparability between financial reporting periods may be compromised as a result of adoption of the amendments. Now, if restating comparatives is important to your organization, then KPMG has a solution for you. In our view, an entity is allowed to make a voluntary change in accounting policy under the existing standards to apply the full direct cost approach before the amendments become effective. If you go down this route, ASB 108 requires that voluntary changes in accounting policies be applied retrospectively, meaning that you will in fact need to restate comparatives to reflect the new policy. Therefore, entities currently applying an incremental cost approach have an option to switch to the full costs approach with retrospective application by implementing a voluntary change in their accounting policy, which would not be permitted if the amendments were early adopted or adopted on the mandatory transition date. I'll now hand you over to Denise, who will provide an update on regulatory matters before I return to talk about some Australian-specific financial reporting issues.
Thanks, Aaron. So firstly, ASIC's financial statement surveillance. Given the timing of our webinar, we don't yet have ASIC's 30 June 2020 surveillance results. These are expected to be released sometime early next year. For the 31 December 2019 reporting season, ASIC reviewed the financial reports of 90 entities. It made 21 inquiries on 40 matters, and the chart shows the areas where those inquiries were made. As you can see, the most number of inquiries continue to be made on impairment and other asset values and revenue recognition. Interestingly, though, for this reporting season, revenue recognition has taken the top spot from impairment and other asset values. For revenue recognition, ASIC looked into 10 matters with a focus on contracts with multiple performance obligations where one or more obligations are still to be met. There were also instances where revenue accounting policies needed to be more clearly described. For impairment and other asset values, ASIC looked into 9 matters with concerns about the recoverability assessment of goodwill, exploration and evaluation of expenditure, and property, plant and equipment. Many of the specific findings remain consistent with previous years. ASIC has also flagged in their media release that disclosures will be particularly important for 30 June 2020 reports due to the wider range of asset value judgments caused by the uncertainties of COVID. We expect that this will also apply to December reporters due to the ongoing nature and impact of COVID. Moving on to the ASIC focus areas. So this slide captures the areas that we communicated with you in our June webinar based on ASIC's COVID FAQs. And these have remained consistent with ASIC's formal release in July. And while the formal media release provides guidance on specific factors that should be considered in each of these areas, overall, the key message of the focus areas relates to disclosures both in the financial report and in the OFR to maintain confident and informed markets. So this means that disclosures should really be clear, specific, and articulated in a meaningful way so users can understand what has happened during the year, including the impact of COVID on your business, operations, and the financial position and performance. Another regulatory update we wanted to share with you relates to the ASX continuous disclosure rules. So for context, subject to certain exceptions, ASX Listing Rule 3.1 requires listed entities to notify the ASX immediately of any information concerning it, which a reasonable person would expect to materially impact its share price. However, given the impact of COVID and the uncertainty it continues to generate, it has been more difficult for companies to release reliable, forward-looking guidance to the market. As a result, on the 25th of May 2020, the government temporarily amended the Corporations Act so that companies and officers will only be liable if there has been knowledge, recklessness, or negligence with respect to updates on price-sensitive information to the market. The changes were initially in effect for 6 months, but this has now been extended until 23rd of March 2021. And this was just something we thought would be good for you to know, but as to how it will be applied and enforced by ASIC, I guess only time will tell. The final regulatory update we wanted to share relates to something we discussed back in our June webinar. In June, we discussed with you supplier financing arrangements and the need to be transparent about the use of them in your financial report. So this still applies and will now have a more heightened focus due to the new payment times reporting framework, which is effective from 1 January 2021. This legislated framework requires large businesses and government entities to publicly report every 6 months on aspects of how they deal with any suppliers that are small businesses. A supplier will be considered to be a small business if it has an annual turnover of less than 10 million. Penalties will apply if entities fail to provide these required disclosures. This legislation has been enacted due to public perception that large businesses are using their purchasing power to their advantage and to the disadvantage of small suppliers. And some small businesses have also claimed that the delays in payment have impacted their cash flow management and ultimately their viability. Therefore, this regime is designed to make information on small supplier payment terms visible to the community, and we expect there will be public scrutiny on these disclosures, especially when they are first made. It's also useful to note that the IFRS Interpretations Committee is currently looking at the presentation and disclosure requirements for supplier financing arrangements. An agenda decision is expected to be finalised at the December meeting, but as Hayley mentioned, this will be subject to the approval by the IASB. So please look out for our communication on this topic once it is released. I'll now hand it back to Aaron to speak to you more on some Australian issues.
Thanks very much, Denise. Yes, our final topic before we wrap up is the update on Australian-specific financial reporting issues. Now, during a previous webinar, we provided an in-depth look at the various projects being undertaken by the AASB relating to the Australian Financial Reporting Framework. In today's session, I will cover a couple of key messages and reminders for you to consider in the lead up to 31 December. Back in March, the AASB finalised Phase 2 of their Australian Financial Reporting Framework project. This effectively marked the beginning of the end for special purpose financial reporting in Australia, in particular in respect of for-profit private sector entities. Concurrent with the removal of SPFS for certain for-profit entities, the AASB has introduced a new Tier 2 Simplified Disclosures Framework, which replaces the existing Reduced Disclosure Requirements regime, otherwise known as Tier 2 RDR. Entities currently preparing SPFS will likely need to make more disclosure under the new regime than they do now. However, the new regime has fewer disclosure requirements overall compared to the existing RDR framework. The mandatory application date of the new framework is for annual reporting periods beginning on or after 1 July 2021, which means it will apply for the first time at 30 June 2022 for June year-end reporters and 31 December 2022 for December year-end reporters. This may seem like it is still some way off. However, it is important to note that some aspects of the transitional relief are only available if an entity chooses to early apply the amendments at 30 June 2020 or 30 June 2021 or the December year-end equivalents. Some of the relief on offer includes, for example, not having to provide comparative information in the notes where the entity did not disclose the comparable information in its most recent previous financial statements. Therefore, it is worth spending some time thinking about the transitional relief on offer and whether they provide a big enough incentive to warrant early adoption. You may recall the thresholds for determining whether a company is a large or small proprietary company for a financial year were doubled last year and were effective for years beginning on or after 1 July 2019. This means that for entities with a 31 December year end, this will be the first year that the new thresholds apply. With doubling of reporting thresholds, it is expected that approximately 1/3 of proprietary companies that lodged audited financial reports with ASIC in the 2017-2018 financial year will no longer be required to lodge financial reports. Some entities may be pleased to hear they no longer need to report. However, it raises other potentially challenging questions for those large proprietary companies that may still prepare and lodge special purpose financial statements. You may remember that a key driver behind the doubling of the thresholds was to ensure that the financial reporting obligations are targeted at economically significant companies, and that the AASB and ASIC have made public statements expressing a view that these entities are more likely to be reporting entities. This is because they are more likely to have users who are dependent on general purpose financial statements, and these users cannot demand that the entity provides the financial information that they need. So, with regulatory focus on whether large proprietary companies are reporting entities or not, if you're a large proprietary company that currently prepares SPFS, we encourage you to reassess your reporting entity status for the upcoming 31 December year end and each future reporting date before the new financial reporting framework kicks in. The AASB has stated that it expects that the directors or those charged with governance will need to consult with their users to determine an appropriate basis of preparation when next preparing financial statements. This may well be consistent with the most recent SPFS, but the issue is that a process needs to be established for consultation with users. This process should consider all users of the financial statements, including owners, bankers, creditors, employees, and any applicable regulators. We would recommend that this process be appropriately documented. Now that Phase 2 is complete, the AASB will be turning its attention to the reporting framework as it applies to not-for-profit entities and the public sector. So with the finalisation of Phase 2, there are 2 more sub-projects to go as part of the wider Australian Financial Reporting Reform Project. In respect to these 2 projects, the Board has tasked the staff with analysing issues raised through research and outreach activities and have requested that they report back during the first half of 2021. Other than this, the AASB will also look at the current definition of public accountability in the future and provide additional guidance on how to assess if an entity has public accountability in the Australian context. The AASB will, however, await the IASB project on the same topic before proceeding further. Finally, KPMG has developed an interactive webpage that contains resources on the Australian Financial Reporting Framework. We encourage you to bookmark this page and check it regularly to keep up to date with all the latest developments in the Australian Financial Reporting Framework project. I will now hand back over to Kim to wrap things up for us.
Thanks, Aaron. So this brings us near the end of our webinar today. And as you plan for 31 December 20, we've listed here for you the key takeaways from today's webinar. Do you have a plan for drafting your financial statement disclosures of the COVID-19 impacts on estimates and judgments that you've made in the financial statements before it gets too busy? Have you considered the changes to accounting standards that apply this December? How do ASIC's focus areas impact you and your organisation? Have you agreed rent concessions in light of COVID-19? And if so, have you worked through how to apply the rent concession amendments? Have you considered whether the new large and small thresholds impact your reporting obligations? If you are still required to lodge accounts with ASIC and have historically prepared special purpose financial statements, do you have a plan in place to consult with users? Hopefully today's presentation has pointed you in the right direction to start answering these questions. We will now spend some time looking at the questions that you have been submitting. Whilst we do so, could I ask that you please complete our survey on how you found today's webinar and what topics you are interested in for future webinars. Before we start, thank you for sending through your questions. Before we start on the financial reporting technical questions, a number of you have been asking questions about the availability of the slides. And just to recap, the webinar recording and the slides will be made available to you. I think they'll be sent out actually, and also available on our website next week. So watch out for that. And then there was also another question from a participant about our lease concession, our lease, the rent concession publication that is available on our website. But what we'll also do is send out that publication when we send out the recording and the copy of the slides. So I guess maybe then we just move on to the financial reporting technical questions. Aaron, there's one here about the disclosure requirements for when the practical exemption for rent concession is adopted, and I guess specifically whether there are any thresholds for disclosures. Could I ask that you take on that question, please?
Yeah, sure, Kim. So I didn't touch on it in the webinar, but there are some disclosure implications associated with applying the practical expedient for COVID-19 related rent concessions. And they are for a lessee who is applying that practical expedient. Well, they're required to disclose the fact that it has been applied, whether they have applied the practical expedient to all eligible rent concessions, and if not, the nature of the contracts to which they have applied the practical expedient. They also have to disclose the amount recognised in profit or loss for the reporting period arising from an application of the practical expedient. Now, in terms of thresholds for what you should be disclosing and when you should be disclosing, there's no bright lines in the standard about what those thresholds are. It really is a matter of judgment and determined based on whether the information is material to the users of the financial statements. And that would be both from a quantitative and qualitative perspective. Now, Kim, I'm interested in whether you might have seen anything in this space recently.
Yeah, I have, Aaron. So I would absolutely agree with Aaron that the extent of rent concession disclosures that you include in your financial statements is a matter of judgment based on materiality. We do know that it is an area of focus for ASIC, and in fact, we have been privy to some surveillance letters that ASIC has sent out where they have asked companies about their rent concession disclosures or lack thereof, and the accounting that has been adopted. And this was in relation to their June accounts, and that might be because that the not many rent concessions were actually negotiated by June, but we do expect to see many more of them negotiated by the end of this reporting period. So it really is a matter of judgment, but just be aware that it is a real focus area for ASIC. There's another question here, Denise, or there's a question here, Denise, with regards to the payment times reporting, and I guess maybe specifically how we can find out more information about what small business is. Are you able to make some comments on that aspect, please?
Sure. So as you mentioned, a small business is defined as having an annual turnover of less than 10 million. But one of the good things that we've understood is that this entire reporting requirements framework will be supported by a tool called the Payment Times Reporting Small Business Identification Tool. And so that I think the idea is that you'd be able to log into this portal, type in that entity name or some of the details, and the results should tell you whether or not they are, I guess, considered a small business to which that reporting will apply.
Okay, thank you, Denise. There was also another question with regards to rent deferrals and whether if there's just a rent deferral, how do you do the accounting for that? And that essentially is basically you are just remeasuring the lease liability, and you're using the original lease discount rate. But we do, if you are finding yourself in that situation, that's one approach which we do illustrate to use in our rent concessions publication. So if that is a particular fact pattern of yours, then you might want to refer to that publication and have a look at the example that we provide in that publication. Let me just quickly look through to see what the other questions are. There's one here with regards to COVID-19 disclosures and whereabouts in the financial statements they should be made, whether it should be in significant events or I guess subsequent events to the extent that it is relevant. I guess from my personal view is that you should make those disclosures where it makes the most sense. And I think typically we have seen them in the significant events, usually in the the section that talks about the impact on P&L, but I guess to the extent that it's impacting your impairment testing, then you should be making those disclosures there. Denise, I'm going to spring this one on you, but when we were reviewing when you were looking through the financial statements and preparing for today, did you have any observations about, where it would make sense to actually make these disclosures? I guess my sense is that it makes sense to just where it makes sense, really. Hello, Denise.
Sorry, you can tell it's live. I've lost a bit of connectivity. Could you repeat the question?
Oh, okay. I was just kind of saying that there was a question here with regards to COVID-19 disclosures and whereabouts in the financial statements they should be made. And my sense is that, my view is that they should be made where it actually makes sense. And I guess our experience when we've been reviewing financial statements has been that it is pretty much dispersed throughout the financial statements and in the director's report. And I just wanted to check with you whether that's when you were preparing for today's webinar and pulling together your section, whether that was consistent with what you've seen, and if you had any additional observations you wanted to make on that.
Yes, no, that's completely right. what we have seen is that they are dispersed throughout, because I guess for a lot of entities, all of the uncertainty that COVID has generated does sort of, I mean, this might not be the best word, but infiltrates all of the different estimates that you need to consider. So we've seen entities talk about in the front of their reports, really trying to explain how COVID has impacted their business or not. You see it in the estimates and judgments disclosures. You might also see it in specific disclosures related to, like we mentioned, impairment of non-financial assets. So how that impacts certain assumptions, similarly with your expected credit losses, and again, even with things like if they've received JobKeeper, you would see some disclosures as to, them being entitled to JobKeeper and how long they expect to be entitled to that. So I 100% agree, and very consistent with what we've seen in the market so far.
Okay, thank you for that. There are a number of questions that you've been sending through that, we have not been able to respond to, because we have, it is a couple of minutes after 1 o'clock. But we do commit to responding to those questions through your usual KPMG contact. So you should be receiving an email or a phone call from your usual KPMG contact with regards to your question. And then, like I said, if you could just watch out for a copy of the recording, the slides, and the rent concession publication, which should be available next week. Thank you so much for your participation and for your questions, and we will hopefully see you at the next webinar. Thank you.